All right. It is 1 o'clock, I guess, my time out here in Toronto. 11 o'clock out on the West Coast, or
in the mountains. 11 in the mountains. 10,
Yeah.
there you go.
At any rate, I think it's time to get started. People are starting to shuffle in, and I'm sure more will be joining us as we go. So good morning, everyone. Welcome to the second Foresight Fireside Speaker Series event. Super excited to have you here today. I think we have a fantastic discussion on the topic of today, which is employee stock option plans, also known as Esops. Today, we are joined by Michael Clark and Scott McCamus from MLT Aikens. Michael and Scott are lawyers who have extensive experience advising clients in corporate structure, mergers and acquisitions, tax planning, and most importantly, they're experts in employee stock option plans. So please join me in welcoming them here today. Additionally, I would like to introduce our moderator for today, Foresight's very own James Chapea. For those who haven't had the pleasure of meeting James yet, his extensive background in corporate finance and business development, he's been able to help hundreds of organizations develop their financial and operational strategy. So we're very grateful to have him here as a moderator today. So Michael, Scott, James, thank you for being here today. And I'm going to just pass it over to Stephen now, who is also going to say just a few words about the event. And so take it away, Stephen.
Thank you very much, Tyler. I will try to keep it brief because I know that nobody came here to listen to me talk. I do want to say thank you for everyone for attending. I see some names I recognize, and I only wish I could see your friendly faces, but we'll deal with it. That's what we get. Quick notes from Foresight. I think all of you are familiar with what we do as Canada's Clean Tech Accelerator, so I won't spend too much time on that. I'm really happy about this Fireside Chat series to kind of provide information on different areas and topics of interest to you. There's only so much we can cover in our core programs, and obviously the world evolves at a quick pace, and there's new updates to regulations, new options, so it's fantastic to have these monthly get-togethers where we talk to experts about the things you need to know. Look forward to next month in October around market dynamics. So we're excited to see that one coming up. And again, we'll be having a monthly. If there are topics that you want us to cover, please do feel free to reach out to us and let us know. Other things of note is we just opened up our registration for the next round of our investor readiness programs. That will be running in November. So if you do yourself are looking for investment in the next 3 to 6 months or know of another startup company in BC who is, please encourage them to register on our website. I will take the time to put a link in our chat box afterwards. And then also of note is you can still register for the Deliver program for the fall cohort, which kicks off in the middle of October. So if you know of any companies who could need help with their technology development roadmap, that would be a great place for them to get that help. That is a pan-Canadian program. So any innovator in the technology space, hopefully clean tech space, would be eligible for that program. So with those updates, I will pass it on to James and the main event.
Good day, everyone. Welcome. Looking forward to this. The only thing I'm going to add, I will help with the moving things along. But if you do have questions, please do not use the chat box. There is a Q&A box at the bottom, and we will attempt to actually address all the questions either through the presentations, or we can some of them we can actually do individually, so you can submit them as this goes on. So I will be watching that as well. Turn it over to Scott and Michael, and look forward to this presentation.
Thanks, James, and thanks, Tyler, Steve, and James, and the rest of the Foresight group for involving us in this presentation. We're excited to be part of the Foresight group and having the opportunity to chat today. Tyler sort of stole our thunder. I was going to introduce myself and Scott as well, but I'm not sure I could do a better job. So I'll just confirm I'm a partner in our Calgary office, and Scott is one of our tax lawyers up in our Edmonton office. And yeah, we'll go through our presentation today. And as James said, happy to take some questions at the end. And to the extent we don't get through them all, we're certainly happy to do some follow up on a one-on-one basis, or if there's a way we can distribute responses to the group, I'm sure we can accommodate something like that as well. But maybe just getting into our show, I'll hopefully advance our slide here. There we go. So for today's discussion, as the title suggested, and as I saw in the chat as well, it was rather obvious, but we're going to be discussing a number of concepts related to stock option plans, or ESOPs, including at a high level, what an ESOP is, how a company adopts an employee stock option plan, some of the more common provisions you'll find in a plan, a couple of alternative approaches to a stock option plan that can achieve similar objectives, but there's some associated pros and cons. And then Scott will take over the discussion at that point and discuss some of the more common tax considerations that an issuer should keep in mind when contemplating the adoption of an employee stock option plan. And then at the end of that discussion, each of Scott and I will share a few observations on some of the, I don't want to say common, but frequent pitfalls that we've seen issuers trip over when adopting stock option plans, and hopefully we can provide some tips on how to avoid those. And one of the most common tips you'll hear, and you may hear it a couple of times today, will be talk to your advisors before sort of embarking down the path. That's it's a lot, to be blunt, cheaper to do it right the first time than to do one and then have somebody come in and try and fix it after the fact. It's almost inevitably a more efficient and enjoyable experience to just get it done right the first time. So maybe that'll be my last pitch to the group today, but I do want to leave that, start off with that thought, and we'll leave it with you at the end as well. So again, we've got the overview of what we're going to talk about. Just getting into sort of what is an ESOP. And as we all likely know, a stock option is a grant of a right to acquire shares in a corporation at a set price over a defined period of time, often subject to the satisfaction of certain conditions. Stock options are often granted to employees, directors, officers, and independent contractors of a corporation. And we'll talk about a couple of different documents through the course of our discussion here. And one will be, we'll refer to it either as the ESOP or the plan. And that's sort of the governing document that sets out the general rules applicable to how the corporation will issue its stock options and the general parameters that will be applicable to the program. And then there will also be option agreements that we'll refer to through the course of today as well. And that's typically the document that's entered into with a particular optionee, the employee, director, consultant, whoever you're talking about that is going to receive the option, that sets out any specific rules that are applicable to that individual, whether it's a vesting period or strike price or whatever it may be. There's a lot, and we'll talk about those as well in a moment or two. I'm going to do my best here not to read the slides, because I know the presentation that's also known as mic reading is not super engaging for everybody. So I'll try and kind of just ad lib a bit here. But certainly there's some information on the slides. I'm sure we can make this available to the group, James and Tyler, afterwards if people want to refer to it. My intent will be to cover off the information, but I will endeavor my best not to just read it, because that will put everybody, including myself, quickly to sleep. So the next slide, we talk about the objectives of an ESOP, and they're, the typical objectives, as probably we all know here, are, either to attract prospective employees, contractors, or directors, or to incentivize existing, employees, contractors, and directors to encourage loyalty and to provide for an alternative, form of compensation to reward performance, and also to tie that performance, the individual's performance, to the performance of the issuer as a whole. Oops, skip too many there. On the adoption front, I mean, it's a relatively straightforward process, and I guess the only caveat would be is if the issuer, the corporation, has a unanimous shareholders agreement in place, or other sort of commitments, whether it's with financial institutions or other institutional investors, whatever it may be, that set other rules for these sorts of things. Generally, an ESOP can be adopted through a director's resolution. And again, through that process, the board would typically approve the plan document, which we talked about a couple of minutes ago. Usually the form of option agreement is a templated document to make it a bit simpler to grant options on as time goes on. That's typically scheduled to the plan document. And there'd also be a notice of exercise form that the optionee would actually fill out and sign and submit to the corporation when he or she wanted to exercise their options. And again, that would typically be scheduled to the option agreement, just for the purposes of not having to go, as much as we'd love to talk to you, not having to go back to council every time you need to do something. You try and set up a program that's relatively, well, not relatively, that is user friendly from the issuer's perspective. Now, of course, if the corporation is a publicly traded company listed on a stock exchange, additional rules will apply. We're not going to get into that discussion today because we can go down an entire rabbit hole of exchange requirements, depending on the exchange you're on. So I think I'd like to sort of stay away from that. But again, can certainly follow up post discussion if there's further questions that are required. Some of the typical provisions of a stock option plan are set out on the screen in front of you here. And as I said at the outset, the ESOP itself, the plan document, is going to set out the general rules applicable to the plan. It'll probably have a statement of the purpose of the plan, typically to incentivize and attract. It'll identify a plan administrator. In most organizations, that would be the board of directors, just who makes the determination of how options are granted, what the terms of individual option grants will be, etc. Eligibility for options, who participates in the plan, the vesting schedule, events of termination of the options, how options are exercised, and if there are any corporate reorganizations, changes to the share capital, what does that mean for an option holder, and how does that individual's underlying shares adjust to reflect the fact that maybe there's been a stock split or a share consolidation or whatever the case may be. So there's again, lots of general rules inside the plan itself. And then when you skip over to the stock option agreement, as we'll recall, that's the document that we would be entered into with the individual optionee when a grant is issued. And that document, typically a lot shorter. It's going to identify who the optionee is, how many shares are issuable upon exercise of the options, what the exercise price is, when that individual can exercise his or her options, the vesting schedule when they are exercisable, and if there's any termination events, for example, when the individual ceases to be an employee, or other events of termination that can be determined on a case-by-case basis. Once an optionee exercises their options, obviously the status of that individual changes. Before they were an option holder, they had certain rights which were governed by the ESOP and the option agreement that they hold. Once they exercise their options, again, this may be a bit of a statement of the obvious, but I think it's important to appreciate that optionee then becomes a shareholder. And becoming a shareholder brings a different basket of rights to that individual than you would with just an option. One of I think the main things to remember, and I'm sure we all appreciate this, is once an individual gets shares in a company, whether it's through the exercise of an option or otherwise, those shares are that individual's personal property. They're their shares. And in the absence of an agreement with that individual that governs, the potential for a repurchase of those shares in certain circumstances, there's not a lot you can do to get those shares back. From that individual. So, and again, I think it's an obvious statement, but it's just important to remember that, what that can lead to is some consideration of whether a shareholder agreement should be entered into sort of in connection with the development of an ESOP, or at least some consideration given to that, to deal with shareholders in the future. And, I'm sure lots of folks have dealt with shareholders agreements either with their existing entities or with previous organizations, and they can be, from soup to nuts. There's no one size that fits all in those agreements either. I think what's important to remember, though, is if there is a desire from the issuer's perspective, and that's who we're speaking from the corporation's perspective, not the individual shareholder's perspective here, but if the corporation wants to have some ability to control who its shareholders are, some consideration should be given to having a shareholders agreement in place. And you can have one-off shareholder agreements just with an individual shareholder, a former optionee, for example, that says in certain events the corporation can buy back that individual shares at, some predetermined price or a fair market value calculation, whatever. Again, there's no template for that arrangement, but what it does do is it does give the corporation the ability to manage who its shareholders are. So for example, if there was an employee, took some options, exercised those options, became a shareholder, and then for whatever reason moved on, either terminated or left or whatever, maybe there's a desire at that point for that former employee to no longer hold shares. Maybe we're fine with it, but if we're not, really the only way we can control that is through an agreement with that individual that says, if you're no longer with us, we can buy your shares back. So getting a bit off the Esop discussion, so I'm throwing a bit of a wrench into the earlier chat about what are we going to talk about today, but just did want to flag that one because it is, I think, for all sort of early stage and sort of growing companies, that's an important thing to always keep in mind is the importance of a shareholder agreement to just sort of manage the relationships between the various stakeholders in the organization. So just my last sort of point before we shift over to Scott here will be to discuss some other tools that can be used by corporations other than an ESOP that have similar objectives, and the key objective being to incentivize whether it's employees, directors, consultants, whoever it may be. An employee stock purchase plan is a common vehicle as well, and in that case, rather than having options granted and there being a deferred exercise, shares are sold to the employees kind of at the front end, if you will, and that employee then becomes a shareholder immediately. So just a slightly different approach to the incentive program. Another option is a phantom plan, and these sort of seem to come and go a bit in sort of whether they're in or out of vogue. But the idea here is to basically create an instrument that would mirror a share's performance. So if the value increases, then that phantom option holder's account would increase in that value. If the shares decrease in value, the account would decrease, and then at some point, on expiration of that sort of individual's rights on termination or whatever the case may be, there would be a reconciliation of the value of that account, and there would be a payment out to that individual of the value of his or her phantom sort of securities. So the one I guess con, well, I mean, looking at the pros and cons there on the screen, you're not actually issuing shares in the corporation, so you're not diluting other shareholders. You're not giving them the rights that are attributable to other shareholders. Rights to financial statements is the biggest one from a shareholder's perspective. There's not a whole lot of other stuff, as we know, shareholders get. There's rights to vote on certain things, but provided they don't have greater than a third of the shares, there's not a whole lot they can do. But they are entitled to financial information, and they can require an audit. So they're shareholders do have certain rights. A phantom holder of a phantom option wouldn't have those rights. From a downside perspective, as I indicated, it does involve a cash payout at some point. And again, that's going to be a drain on cash. And for every organization, particularly sort of emerging and sort of early stage companies, that can be less attractive because it does require some cash out of the till. And then the final option that we often see sort of as an incentive opportunity is a profit sharing plan, or a deferred profit sharing plan is another way that's described. And again, it's, as the name suggests, the employees will share in a portion of the corporation's profits. Again, it preserves equity from the founders and the owners' perspective, but it does provide incentive to drive growth, because the better we do, the more dough I get as an employee. Again, like the phantom plans, it does, it has the potential to create some pressure on cash flow for the organization. So depending on where things are at, that may or may not be a feasible option. And I think perhaps to the delight of everybody, I will now pass it over to my colleague Scott up in Edmonton, and he can give you some rest from my droning and talk about some of the tax considerations associated with a stock option plan. So over to you, Scott.
Thanks, Mike. So I'll try and just summarize the tax implications of stock options fairly quickly and in a reasonable level of detail. And just by way of context, I'm sure everyone's probably aware that most employment income, like if you receive a salary or a bonus, is taxed when it's received. So you receive the cash, you're taxable in that year. And normally an employee doesn't really have to worry about it because the tax is all deducted at source and the employee effectively only receives the net amount after tax. But stock options and shares are non-cash benefits, so that wouldn't really work very well for stock options. So the tax rules recognize this, and we have this whole different regime that applies to taxation of stock options as opposed to other employee compensation. And it recognizes that, number one, we're dealing with non-tax benefits, and furthermore that there's a distinction between publicly traded shares that are readily marketable and can be converted into cash almost at any time versus private company shares, which tend to be very illiquid and may have no defined market or may not be able to be converted to cash for many, many years. So there's this separate regime. We say there's a sort of a complete code for taxation of stock options. And we usually tailor our stock option plans to fit specifically within this regime because happily, often, sometimes the tax considerations are all bad news, but in the stock option world, there are actually some really excellent results you can achieve by fitting within these the tax rules for stock options. So, and we'll just sort of what do we need to do to fit into this regime? Well, number one, and Mike already discussed this. This is a regime for taxation of stock options to receive actual shares. So we're talking about real stock options, not phantom plans at this point. Phantom plans are taxed more along the lines of sort of actual salary. And there are a few requirements in order to fit within these rules. So we have to issue shares under an agreement. We already discussed that. The shares have to be issued to an employee, and for this purpose, employee does include a director or an officer, but it does not include a consultant. So that's something we need to watch for. We sometimes see option plans, and they may provide options can be issued to everyone, employees, consultants, whatever the case may be. But there's a big distinction that employees fit under the stock option regime and consultants do not. And finally, in these rules, there's a stark distinction between a Canadian-controlled private corporation versus another corporation. And very briefly, Canadian-controlled private corporation, or CCPC, what that means is a corporation not controlled by any combination of non-residents and public corporations in any manner. So if we're dealing with investors who are non-residents or public corporations, we may need to be very careful about the terms of our shareholder agreements, et cetera, so that we're making sure that we qualify as a CCPC, because there are very different rules for CCPC options versus public companies. So on the next slide, we just have a note here that given the audience today, we're going to be talking about the rules for CCPCs, because we don't think the rules for public company options really will be as relevant to our participants. So just as a bit sort of summarizing what Mike had said, for tax purposes in the structure of options, there are several dates that are sort of relevant. We have the date of grant, when options are granted initially to the employee. We may have a date of vesting, so options may immediately vest on the date of grant, or they may vest over time on a fixed schedule, or perhaps it may be a performance-based vesting when certain milestones are achieved. And then we have the date of exercise the option. So once it's vested, the employee can exercise the option, pay the exercise price, and then the actual shares become issued at that time. And then finally, in the event that the option isn't exercised by the end of the term, which is usually specified at a fixed date, the option expires and ceases to exist, and the shares notionally go back into the option pool and are available for use for other employees. So on the next slide there, just to summarize, the most important point is that stock options are non-cash benefits. So if we had immediate taxation every time we received options and exercised them, we are immediately taxed. That would be a big problem for the employee, because they haven't received any cash. The shares are not liquid. They can't just fund a huge tax liability. But happily for CCPC options, the key point here is that if an arm's length employee receives an option and exercises the option to acquire shares, the taxation of the benefit is deferred until a later year. So the employee doesn't have a big tax bill at the time they've exercised an option and acquired the shares, but instead they can continue to hold the shares. The tax is sort of crystallized at that time, but it's not payable yet. And then ultimately down the road, when the shares are sold and there's a liquidity event and the cash flow is realized, that's when we have an event for tax purposes. So that's the one big benefit of the stock option rules. And the second is that in some cases, the benefit that's received by an employee, because the value of the shares they receive would generally exceed the amount they paid for them. And in some cases, only 50% of that benefit is taxable. So it, although there is obviously a tax liability and there's tax payable on the benefit, stock option compensation may be more beneficial to the employee than other regular types of compensation like salary and bonus because of this 50% deduction. So it's effectively taxed at a lower rate than other employee compensation. And then we just have a note on the slide there that for other types of compensation, we have other rules like the salary deferral arrangement rules that limit your ability to defer tax on compensation. And again, as we said, the stock option rules sort of constitute their own complete code. And so they displace all of these other rules that apply to all the other sort of salary and other types of compensation. So it's very, very important that we, at the outset, it's a motivating factor, and we want to make sure we structure our plans right from the top to make sure we fit within the rules we want to fit into, instead of just sort of setting up a stock option plan and seeing where we end up down the road. So on the next slide, just getting a bit more specific on when a CCPC issues options to an employee, assuming that we've met the requirements of all these rules, what does that actually look like for tax purposes? So very briefly, the grant of an option is a nothing for tax purposes. So nothing happens on that date. The employee isn't taxable yet. And the vesting date is also a nothing, so nothing occurs there. For the key for tax purposes is that the exercise of the option is a taxable event. So the employee exercises the option, pays the exercise price, which may be quite low, acquires shares with a certain fair market value, and so the employee then becomes subject to an employment benefit or employment income equal to the benefit received, or the value of the shares less the amount paid for them. But then as we said, if we have a Canadian controlled private corporation, so not a public company, this tax liability isn't realized on the date of exercise, it's further deferred. So the employee has acquired the shares but doesn't have to pay this tax liability until down the road when the shares are ultimately sold. And then just a note on the third bullet there that this deferred employment income benefit is added to the cost of the shares for capital gains purposes, and that just ensures that there's not double taxation, that we're taxing the same amount twice, first as employment income and second as a capital gain. And then furthermore, for Canadian controlled private corporations, there's no source deduction withholding required. So it's a non-cash transaction. We don't have to sort of find a way to withhold a benefit from the employee's other salary. But for non-CCPC options, we don't have that benefit. So we would also have to worry about source deductions and withholding on the stock option benefit. So again, very favorable rules for CCPCs, recognizing that stock option compensation is very important to their growth, and that it's a non-tax benefit, and they can't. It's not a liquid cash benefit you can use to pay tax. So just more on the taxation of options on the next slide here. Again, when the shares are sold, that's when the deferred employment income benefit is recognized. And as we said, the employee has received a benefit because the fair market value of the shares received exceeds the amount paid for the shares. We'll have an example on this later to actually put some numbers to this, and hopefully it'll make a little more sense. And again, there's a 50% deduction. So the employee is effectively only 50% taxable if there are two ways to qualify. And one is if the shares are held for at least 2 years before they're sold. Or the second is if the option is to acquire common shares and the options when they were granted were not in the money. So in other words, on the date of grant, the exercise price to exercise the options and acquire the shares was at least equal to the fair market value of the options. There was no benefit to be realized on that date by exercising the options and acquiring the shares. So those are the two ways to qualify for the 50% deduction. And then just have a note here that ultimately on the date of sale, the difference between the sale proceeds and the cost, which was increased by the amount of benefit. So any subsequent fluctuation in value of the shares is taxed as a capital gain or capital loss. And just one one important note there. There is a difference between a sale to a third party, which is generally taxed as a capital gain or loss, and a sale back to the corporation or redemption of the shares is usually taxed as a deemed dividend. So when we're setting up our shareholders agreement, we really have to be aware of that, that if the shareholder is holding the shares and selling them on the market to a third party or a purchaser, they would expect to realize a capital gain or capital loss. But if our shareholder agreement says the shares will be redeemed, that could be a problem for the employee, because you could have these mismatches where the employee is realizing like a deemed dividend and a capital loss on the shares, and it can be a bad result. So it's just important to plan our shareholder agreements to be aware if shareholders are acquiring options and potentially have some tax implications. So I'll just sort of summarize very briefly, as between CCPC options and public company options. The key points for CCPC options are that, number one, the exercise of the shares is not taxable because you're deferring that tax benefit out until you sell the shares. And number two, employees, because of this 2-year holding period to qualify for 50% deductions, employees have an incentive to exercise options early and hold the shares so they can hold them for at least 2 years, so that when a liquidity event ultimately happens, the employee hopefully will qualify for that 50% deduction at the time. So in public companies, we usually see employees holding off and waiting until they exercise their options and sell the shares immediately into the market. But in private companies, there may be an incentive for options to be issued in the money, or maybe very deep in the money, and then employees can exercise very early and hold the shares to satisfy this 2-year period before they sell. And there's a note in red on the slide there that there's been a lot of coverage in the media about this new $200,000 annual limit on stock options to employees. We won't get into that. It only applies to non-CCPs with very large annual revenues, so likely not relevant to the audience in this discussion. So that probably sounds a bit confusing, but we'll just go through an example here. So suppose we have a startup that's a CCPC and an arm's length employee, and the employee is going to receive 1,000 options to acquire shares at $10, which is equal to the fair market value on the date they're granted. And the options, maybe they vest immediately, maybe they vest, in this example, 1/3 per year over 3 years. And the share value is going to grow over time, so that in later years, the fair market value of the shares is greater than it was on the date the options were granted. So say that our employee receives these options in year 1, exercises the options in year 5, and at this time the share value has increased from $10 to $37, holds them for a year and then sells them to a purchaser for $48 in year 6. So we went through earlier, the grant of the shares is a nothing. The vesting of the shares is also a nothing. On the exercise of the options and acquisition of the shares, we have a stock option benefit, but it's deferred. So in year 5, when the options were exercised, the employee doesn't have to pay any tax at that time, but the benefit is crystallized. So the shares were worth $37 and he only paid $10. So there's this benefit of $27,000 hanging out there just waiting to be taxed. And then that's added to the cost of the shares. So the cost of shares for tax purposes becomes $37,000. And then on the next slide, on the ultimate sale, where we've had these shares that we paid $10,000 for and we've sold them ultimately for $48,000, we bring into income our deferred income benefit of $27,000, but we qualified for the 50% deduction because they were at the money options. So we qualified for this deduction. So the $27,000 benefit is effectively only taxed at a 50% rate. And again, no source deductions on the benefit. And then on sale, the rest of the appreciation of $11,000 from year 5 to year 6 is taxed as a capital gain. So at the end of the day, we paid $10,000 for the shares. They were sold for $48,000. So there's an economic benefit of $38,000. If we received $38,000 in salary, we'd be taxed at, in Alberta, 48%, in Ontario, about 53.5%, I think. But under the stock option rules, we only pay essentially half that amount because the employment benefit was only 50% taxable, a capital gain is only 50% taxable. So we received this economic benefit and essentially only half of it has been taxable under the stock option rules. And the last note on the slide there is that in some cases, the capital gain on sale of shares may even qualify for the lifetime capital gains deduction and may be effectively tax-free. So that's an even better result. And then just moving on to the last slide, again, just summarizing, this is an excellent result for the employer and the employee because our employee has received this economic benefit and only paid tax on half of it. So he's better off than if he had received cash, salary, or bonus. He's only paid half as much tax. And he's deferred the tax. So he had received options, he received shares, but it was all effectively non-taxable until the year of sale when he actually received the cash and was able to fund his tax bill. And I'll just make one final point. As opposed to salary, we should also note that for issuing these stock options, the trade-off for the corporation would not get to deduct the options or the compensation provided. So it is a better result for the employee, but there is no deduction for the employer. So that's just sort of a simple example summarizing the rules. I know it's probably a lot to take in, but that's sort of all we had prepared in the slides. So I think James, we're happy to sort of take Q&A or go through some examples, however you want to move forward.
Thanks, guys. I know that there's question Q&A in the chat box. You can take a look at it. And I've got a few questions myself. So thanks so much for this. And as everybody can actually appreciate, there's a lot to go through here. So I think to your earlier point, making sure that you talk to your advisors is exceptionally important. And we're going to actually try and make this even more confusing as we go through this. So one of the points you talked about is the tax is going to be driven by what was fair market value. And you're talking about really early stage companies. So how do you set fair market value? You may not have done an issuance. So it becomes this nebulous kind of concept. So Scott, how would you actually address that?
Yeah, that's an excellent question, James, and I'm glad you brought that up. Because as you said, the rules sort of depend on you being able to value the shares at some point. And the value is very difficult to arrive at because for these early stage companies, it's not quite the same as valuing a company with a mature company with stable cash flow, et cetera, that's, just has comparables on the market. So you do have to come up with a value. It doesn't necessarily, it's a value to be reported for tax purposes. So it doesn't necessarily have to be like a full-blown CBV type valuation for each employee every time you're issuing a T4 to report a deferred stock option benefit. Depending on the circumstances of the company, you may be able to leverage and use your financing rounds. Like in some cases, if you've had some financing rounds, some people will rely or utilize on the last financing round to establish a value that's sort of a reasonable approximation of where you're at. Or you might just sort of, again, if you don't have all of those, all of that evidence to sort of point to, you just have to sort of do the best you can. But it is an important point because you do have to come up with a value in order to establish the amount of the benefit the employee is realizing. And yeah, there is definitely some uncertainty there. So although the benefit is generally deferred, so you don't have to pay the tax right away, you do have to determine the amount of the benefit up front, so that you know where you're at down the road. So yeah, it is an important point, and it's something you have to consider how you'll approach it.
So question for you. So you actually said the day I actually would exercise my options, it's exercised, there will be a price potentially in the market at that point in time because I've done something. Now, no taxable event actually happens, but we will determine then what will become employment income at that event. And I think that the way you've actually addressed this is good because you say, well, we have the price. I know what my exercise is. We now know when I did the exercise, this is now going to be my employment income between this, deferred, so I don't have to pay for it. After that, if I read it correct, from that point to the date I sell, that portion is going to get treated as a capital gain as opposed to employment income. Now, the one thing what would happen if I exercise it. I've now set a value for how much I'm going to be taxed on. But when I go to sell, or let's just say, sometimes not everything works out great and the company now fails, or we actually sell it for a lot less. Am I still paying tax on that higher amount? And the reason I'm asking is maybe that determines how I actually want to utilize these options as a holder.
Yeah. So another really good point, that if we knew in advance that the shares were always going to go up in value, everything would be great, and we could exercise the options early and then hold them for at least 2 years, and we would get a 50% deduction on the stock option benefit, and then the balance would be a capital gain or maybe a capital gains deduction, and the tax result would be really good because the employee would be taxed at 50% or less on the whole economic benefit. But like you said, if you exercise the options, you've crystallized this employment benefit, and the shares could go down in value. And that's generally a problem, because the employment benefit still is what it is. It doesn't change. It's crystallized on the date of exercise. And if the shares drop in value and you realize a capital loss, although the employment benefit might seem like a capital gain because it's 50% taxable, it's not a capital gain, it's employment income. So if the shares decline in value, the employee can be caught in a trap where they have no economic gain, but they have employment income and a capital loss, which don't generally offset each other. So that is a trap, and you can end up in a circumstance where the employee has no economic gain, but does still have a tax bill, and is stuck sort of trying to find a way to use up this capital loss that they've realized, and won't get into, there are other considerations like whether the shares qualify for an able or an allowable business investment loss and other things. But yeah, so
Okay.
Your question is a great point, that if the shares go up in value, everything's fine. But if you crystallize the employment benefit and the shares go down in value, there is this tax trap where your employment benefit doesn't offset your capital loss, and you could get stuck with a tax bill.
Let's go to something happier. Let's deal with that. Okay, so let's say we're going way back to square one, where we're going to actually set this thing up, and you've retained your counsel, you're going through the process. How big can I set these option plans? And how do I set what is the size of the plan? How are those typically done? Is it a percentage of the amount of float, or how do we look at it? And have you seen what the guidelines tend to be as to, based on the companies that you work with, what size of them? So, what have you seen in that area?
Yeah, Mike, do you have thoughts, or do you want me to address that?
I was on mute. I wasn't going to start talking, but I was trying to find my button. Yeah, I mean, I'm happy to have your thoughts on this too. But as I alluded to at the outset, in the context of a publicly traded or a listed company, there are obviously a lot more restrictions on the size of plans, and I think that's what people tend to sort of look at when they're setting up these plans. Is they kind of operate or they think of the rules applicable to publicly traded or listed companies and the restrictions that an exchange will put on sort of the size, the availability of sort of the float to be used for options. But I think I think there's a great deal more flexibility in the CCPC sort of unlisted company context. So I think it's less of a concern in the situation of the companies we're dealing with here or talking to today versus a publicly traded company that would be listed on exchange. But I don't know, Scott, if you've got sort of more on that point.
Yeah, I guess what I've seen, and I mean, James and your group probably have a lot of experience with this. What I see usually is the stock option plan generally would include a fixed percentage of the total share float that the directors are allowed to issue as options. So just pick a number, it might be 15%. The stock option plan will say, the directors can issue options for up to 15% of the outstanding common share capital. So that sort of just establishes the parameters on the directors, that the directors have a lot of flexibility to structure options the way they want, but there's always a ceiling that they need. It protects the shareholders by making sure that they'll only get diluted to a certain point. I think it's fairly common that when you start going through financing rounds and involving more sophisticated investors, they have requirements on sort of what that ceiling is allowed to be. So in early stage companies, I might see numbers of 15%, maybe a bit higher, maybe even up to 20%. But I think that tends to drop a bit as you mature and go through financing, or maybe closer to like 10% in later stages. So that would be sort of a rough approximation.
So let's just say then, because it goes to one of the points you said about, setting the exercise price when you don't have a fair market value, or you may have some people had subscribed at say $1. And if you're really limited as to how many options you can issue, and now this is an extremely important form of compensation to attract and retain employees when you may not have as much cash to be putting out. So if we've got say limitation on the 10% or 15%, do you see companies saying, well, because it's a nebulous concept with respect to how much my exercise price is, if I issued and I gave you a $1 exercise price, or I gave you a 10-cent exercise price, I now can have that ESOP extend over a lot larger number of persons, and really that tax benefit may or may not happen, and it's not the company's issue, it really is the receiver's issue as to how they're addressing that. Do you want to provide some thoughts as to how you can make these plans when you have a very small company, a very small float? And I know as a public company you're limited, but as a CCPC you may have different ways of looking at it. And I'm not going to suggest you're giving anybody tax advice as to what they should or shouldn't do in this presentation. So Chatham House rules.
Yeah, so I got like at one point I guess we can emphasize is that the way the CCPC regime is set up, it really allows you to issue shares that are deep in the money. So you can really go with that nominal exercise price where you can say, okay, employee, you can buy the shares for $1 per share, even though they're worth much more. And the tax benefits, subject to your comments about the shares declining in value, et cetera, the tax benefits really can work out well. And that sort of lets you leverage the pool really well and sort of provide the maximum incentive for the shares you have available. And we do see sometimes where there's sort of a reluctance to use stock options in that manner, because the founders may not want to be diluted or give up these incentives up front to new employees and things like that. And so we do see cases where the stock option, the exercise price is set very high and maybe too high, so that the employee, number one, can't necessarily afford the exercise price or doesn't want to take on that level of financial risk. And it's also eating up a lot of your option pool. So you only have so many shares to go around. And if you're issuing, a huge number of shares to some employee at a high exercise price, you're maybe not getting sort of the incentive value that it was intended for. So we do see that where the employees are worried about dilution, founders are worried about dilution and not giving away all the value of the company. It just ends up being the economics just aren't really great for the employee, where it's more of it's almost being used more as a buyout than it is as an incentive for the employees.
Okay. That touches on something else that I think is actually, we keep bringing up here. CCPC is obviously a really important aspect of this. And as we all start, we're typically Canadian controlled private corporations. That's who's invested in us. But as we may move down this path, there's this potential issue that we bring in outside investors, and we may actually have bringing in what we think is a Canadian investor in a fund, but my understanding is that there's a look through, and if the investors in that fund actually aren't Canadian, then that won't be a Canadian fund. And what would happen? What happens when you change? You're no longer going to be considered a Canadian controlled private corporation. Say you reach, would it be 50%? And
Mm-hmm.
What would happen to those that's they're now holding? They've already been in this, so you now have options in this, but now you're growing the company and you've raised money, which now throws you offside of, you're no longer a CCPC. You're not a public company, but you're no longer a CCPC either. So what happens then?
Yeah. So, and just sort of to, clarify or review, the name CCPC, or Canadian Controlled Private Corporation, technically is a bit of a misnomer, because it's not, the test is not, are you Canadian controlled? The test is, are you not controlled by non-residents or public companies? So it sounds a bit complicated, but if we have, Canadian corporation controlled by a US corporation controlled by a Canadian corporation, it seems like you're Canadian controlled because you're Canadian controlled at the top, but you're actually not a CCPC, because at one level you're not Canadian controlled. So just a note to people to sort of beware that just don't assume that you're Canadian controlled if there are non-residents or public companies involved. You need to get some advice on that point, because it's critical. And so James, to your point, most of our startup companies will fairly clearly be CCPCs at the start, and then as they get more sophisticated and involve other parties, that status may sort of become in doubt later on. And as we said, if you cease to be a CCPC, you can certainly still issue options, but you don't get these particular CCPC benefits. So at that time, you likely would need to issue options on more of a public company plan, like fair market value options, no deferral, just a whole different sort of paradigm. So
My
if
grandfather, though, like if I'm already holding some, or do I lose it immediately?
No, so there is a grandfathering. So if the options have already been issued and the employee holds it, the status is preserved as long as the option's outstanding. So you can issue options to your employee, and then you go public or become foreign controlled or whatever the case may be. The employee is still fine, because the options were issued by a CCPC, and so that employee is not affected. But then, and they're all, if a transaction happens, there are also some rollover provisions if the employee is exchanging options for options of the same company or options of a different company. So there is grandfathering, and there are rollover provisions that prevent your existing options from being affected. But once that change occurs, that would have a significant effect on any additional options that you want to issue going forward.
Okay. Taking a little different, there's obviously there's a lot of consideration that has to be put in place when you put the ESOPs in place. And you're doing this, you're doing it to actually try and grow the company, to get the people that you need, because that's absolutely critical. I'd like to get your thoughts on the change of control clauses that typically go into this, because if we're talking about public companies, often we see that there'll be in a change of control, there'll be a non-cash settlement, so that we can actually just force everybody. They just get paid. We get rid of all these options. It's clean. I don't need to track down the people to actually go and purchase the shares and then sell them and potentially jeopardize my transaction. But when you're looking at earlier stage companies, there may be a situation which you merge two companies together, and so one survives, one's not. You're actually using that to grow. Theoretically, it could be a change of control. So if depending on how you document it, it could actually cause you to have to make cash payments. But if it's just a merger, have you seen that where the structure of an ESOP could actually derail different transactions that you're trying to grow the company? Maybe Michael can comment on that as well.
Just looking for my button. Yeah, and Scott, feel free as well. But I think what you try and do in situations like that, and I kind of alluded to it very, I think earlier in the presentation when I mentioned sort of adjustments for sort of reorganizations, et cetera, and there could be provisions in the plan that could contemplate these types of things. Obviously not a particular transaction, but oftentimes, if there's a share reorganization or reclassification, or potentially a combination of entities, the plan itself could contemplate how existing options in company A, for example, and company B as well, I guess, would be dealt with in the event of that type of a transaction. And I think the idea would be for them basically to carry forward into the resulting entity, whatever it may be, whatever the nature of that transaction was. So I think ideally, subject to how your plan is drafted, the program would be able to sort of continue to roll along into the new entity and continue without the need to sort of buy folks out or buy option holders out or whatever the case may be and create drain on the company's cash resources, but just basically allow it to continue, but reflecting that it's no longer company A, it's, company AB, whatever the resulting entity is. But again, that would be dependent on how the plan itself is drafted. But I think typically you'd find those types of provisions in the body of the plan itself, to contemplate those types of, reorganizations at a corporate level.
Okay. I know we're trying to get through other questions that have been answered. I don't know if you guys can to provide some of those as well. But one of the things that did come up is, so if shares are issued as opposed to, like, we're actually issuing shares to somebody as instead of the options, that would be that would be a taxable event as opposed to what these are tax deferred events. Is that correct, Scott?
Yes. So the stock option rules only apply if shares are issued under an agreement.
Okay.
So that's where Mike sort of talked about, we want to be very sure that when we're setting up an option plan, we're preparing this stock option agreement between the employee and the company, so that we have this agreement, the shares are issued on the agreement, we know the rules apply. If I think maybe your question, like, are you saying if there's just a discretionary stock bonus, like the company just issues stock to the employee, there's no agreement, they just do it? Yeah, so that is not a stock option. And that falls more under the ordinary rules, where the employee has just received employment income and the corporation has paid compensation it can deduct. So yeah, that's a different situation, and we want to make sure that if we're doing that, we know what we're doing and we know why. Okay.
Now, you'd made in the presentation, you'd actually said that this applies to consultants as well. Are there the exact same? Because I've heard of some things where that may not be the case, where consultants could get treated differently. And like, would a board, I know a board of directors would be considered an employee, but an advisory board may not be. So do you want to comment a little bit about, is there any issues with respect to consultants and advisory boards and using this for those individuals?
Yeah, so to be clear, these rules apply to employees, and employees for tax purposes, it includes a director, it includes an officer, but it does not include an independent contractor. So the term consultant, I guess, is a bit nebulous. Not clear legally whether that refers to, it seems to sound like an independent contractor as opposed to an employee, but the legal distinction is employee versus contractor. And if we're in a contractor, so carrying on their own business, providing services as opposed to being an employee of the business, they do not fit into this regime. And so they don't qualify for the same benefits. And there is a bit of uncertainty as to how contractor options should be taxed in some cases, just in terms of how they should be valued and those sorts of things, because they're not subject to the same rules where the grant is a nothing and the exercise of the option is a taxable event. None of that code applies to contractor options. And so contractor options are sort of just taxed under general principles.
Okay, so
and sorry, James, maybe just one quick follow-up to that, if I could jump in quickly.
Sure.
So in addition to kind of the tax implications of that, one of the common pitfalls I think we've seen is, from a securities law perspective, when options are issued, as we probably all appreciate, an option is a security, so it is subject to the securities regulatory requirements. Generally, sort of I think we all know when you issue securities, you have to use a prospectus or rely on an exemption from the prospectus requirements. Now, when you're issuing, most of our entities or businesses we're talking about are probably under the private issuer exemption. Under 50 shareholders have issued securities to a fairly limited scope of people: directors, officers, employees, founders, accredited investors, friends and family, that sort of close held group. They haven't gone beyond those borders, if you will. So they've retained their private issuer status. In the definition of a private issuer, a consultant is not included as this is not a defined term, but a consultant is not an eligible investor for the purposes of the private issuer exemption. So one of the concerns can be, if an issuer wants to retain that private issuer status, And really the main benefit of that is you don't have to file reports of trade with with your local securities commission when you do exempt distributions in the future until you cease to be a private issuer. But if you do issue to consultants, they're not included in the list of kind of eligible investors under the private issuer exemption. You lose that eligibility, and then you are, once you've lost your private issuer status, you can never get it back, for lack of a better way to say it. So that's another, and we never really touched on it, obviously, the securities law implications of any of this, but anytime you're issuing securities, and sort of my last public service announcement is, ensure you're speaking to counsel about kind of what the implications are to the issuer on issuing those securities, to make sure that we're on side and we don't have somebody coming back with effectively a potential put right down the road because we didn't have an appropriate exemption for that individual or investor to rely on.
Thanks, guys. I know we've hit our time limit. I don't know if we have the contact information here. Definitely appreciate it, guys. It was fantastic. I know we covered a ton of stuff. Basically, what I wanted to make sure is everybody understood. There's a lot of issues that need to get addressed. It's challenging. Make sure you guys do this right. You will have access to, there's the contact information for both Michael and Scott. This is absolutely super important to get it right because something that was said earlier, it gets really expensive to fix and it could actually literally jeopardize your company if you messed it up. I've seen that. There's all sorts of vesting issues we have not covered. There's just way too much stuff to cover in an hour, but hopefully it gave you guys a flavor for what to consider and recognize there are no stupid questions. Go ask the questions. Again, engage with your advisors, get it right. And this is a exceptionally important aspect of being able to grow your companies. Thank you for participating. Thank you, guys. Look forward to working with you guys in the future.
Great. Thanks very much, James and Tyler and the rest of the group.
Thanks very much. And thanks everyone for attending.
Yep. Thank you, everyone. And for everyone in the attendees, we can share all the slides and the recording of this meeting with you afterwards. So thank you everyone for being here. Thank you, Michael, Scott, and James for having this conversation. It's been super interesting and super valuable. So thank you.
Thanks, guys. Later.
Thanks,
Take care, everyone.
Have a good day. Bye-bye.
Thank you.